So we are back with our portfolio management series. Last time we spoke about punting stacks of cash to Uncle Sam, asset location, ways to structure our portfolio so we can optimize or increase our after-tax return without having an opinion about what the market does next. Today, we're going to drill down a little bit deeper and discuss specific assets that trigger some of these capital gains or taxable events that might not be so obvious. So specific assets that you would own in a taxable account that are the most tax inefficient. So let's get to it. And the first thing we're going to talk about, and if you say, hey, Nick, I'm sick of you saying this, well, and you can see on my screen, we're going to be talking about mutual funds and taxable accounts. I'm absolutely shocked at the number of mutual funds I see in taxable accounts from prospective clients. So while I talk about this a lot, it's common knowledge that ETFs are superior. If you didn't catch my last blog post about the inner workings of ETFs and why they're so tax efficient, I would encourage you to check that out. And in that post, I outline, even though people know about ETFs and how superior they are, both in cost and tax efficiency and asset class exposures, and I can go on, people still are stuck in this antiquated world of mutual funds. And a lot of advisors, especially at big Wall Street firms, use mutual funds because they're paid to use mutual funds. Their company they work for has lucrative agreements with mutual fund companies to place client assets in those strategies. So while it's accepted that ETFs are better than mutual funds, in practice, that's not always what we see. And from an industry standpoint, the mutual fund complex is still 4 times that of the ETF complex. So that's why I'm beating a dead horse. But this screen I'm showing you shows the percentage of funds that pay out a capital gain. And let me scroll down here a little more. The light blue or teal color is mutual funds. And you can see the year and the percentage of mutual funds that distribute capital gains over here in the y-axis. And then you see the percentage of ETFs in dark blue that distribute a capital gain. And I'm going to show you where you can actually find this on a mutual fund site. So at the end of the year, these mutual fund companies will announce how much is getting paid out to shareholders, which would be the owner of the fund, in the form of capital gains. Note, you don't have to do anything to get saddled with a capital gain in a mutual fund. So normally you would think, okay, if I sell something, maybe I paid $100 for a stock, I sell it at $150. It's very logical to see that you'd owe $50 in capital gains multiplied by your tax rate. That's logical, that makes sense. What doesn't make sense is owning a mutual fund, doing zero selling and owing capital gains at the end of the year. That's what we're talking about here. So scrolling down, this is just a sample, a snippet from American funds, and I'm not picking on American funds. There's nothing wrong with them. They've actually been a pioneer to lower overall mutual fund expense ratios ahead of some of their competitors. So kudos to American funds. But what you'll find is this report where it's showing what date the capital gain is going to be distributed. You can see the fund here, and you can see the dollar amount of capital gains that's going to be flowing out. Okay, so this is a per share amount. So if you own 100 shares, you're going to be paid about $200 in capital gains, which you will multiply by your long-term capital gains rate. That's what you're going to owe to Uncle Sam at the end of the year. So scrolling back up, you're going to get a dividends and distributions form in the mail, a 1099 showing capital gains from mutual funds. So this amount plus your qualified dividends, ordinary dividends, any taxable investment income is going to be reconciled on this year-end tax form. You might be paying attention to this. You might not be. If you work with a CPA or don't do your own taxes, you're probably not paying attention to this. So what I'm saying is the number one offender and the number one cause of tax drag is owning mutual funds in taxable accounts, non-retirement accounts. I would go as far to say, if you're working with a financial advisor and they're buying mutual funds in taxable accounts, in my opinion, that is a fireable offense. That breaches so many basic portfolio management 101 rules. And that to me just shows that they're not on their game. Maybe they don't know any better. Maybe their company's making them buy those funds. I don't know, but that's not good for the end client. Okay, now let's get into the other offense. And these have become a lot more prevalent given the interest rate environment. So the Fed interest rate complex has caused investors to search for income, to search for yield. There's still this section of investors that is conditioned to focus on income if they're retired. Like I'd like to live off the interest in my portfolio, or I need to take 4% out of my portfolio without invading principal. I think that way of thinking is antiquated because the 4% rule was created during a time where the 10-year treasury was yielding like 7%. It's much easier to build out a safe allocation of high quality bonds and generate the appropriate income yield in that type of environment. Extremely hard, impossible to do that with investment grade treasuries or investment grade bonds, I should say, in treasuries in this environment. So you have investors reaching for yield, reaching for return, and how that manifests itself in taxable accounts. Again, I'm talking about taxable accounts, not retirement accounts. Well, we see dividend-centric strategies, so dividend-paying stocks, high-yielding dividend-paying stocks, master limited partnerships, preferred stocks, floating rate securities, income-producing strategies held outside of a retirement account, which, again, it's not the worst sin, but think about dividends. They're very tax inefficient. There's no way for us as professional investors to shelter a dividend from taxes. So what I'm telling you is if you're fixated on income, which I don't agree with that, but that's fine if you are. If you're fixated on generating income, do not own income-based strategies within a taxable account. Own them in your IRAs, in your 401k, in your Roth accounts, because all of that income produced is no longer taxable to you at the end of the year. If you own those various income producing strategies in a taxable account, you're going to be saddled with a tax bill at the end of the year. So interest rates are lower. That's causing you to reach for yield. You're paying taxes on that outsized yield, which brings you back down on your net after tax return. And you're probably introducing a boatload of risk because dividend paying stocks are not a proxy for bonds. Master limited partnerships are not a proxy for bonds. Lower quality bonds are not a proxy for investment grade bonds. So you're seeing people wanting to replace this income. What they end up doing is saddling themselves with taxes and taking on much more risk than they set out to. If you want a frame of reference, go back to my last video on asset location. What we're trying to do is helping investors, even if they're not pure clients, harvest the low-hanging fruit and optimize the things that they control. And again, no one likes to blowtorch money to Uncle Sam. Everyone likes to lower their tax bill. So hopefully you can use some of these principles and give yourself a better chance of a favorable outcome. So in the next video, we're going to get into, am I diversified? Which is kind of a broad topic, but I'm going to point out a few things that I've noticed in client portfolios that make it really hard to understand if you're diversified, and some of the things that you can do today to help you understand your portfolio's range of outcomes and if that jives with your tolerance for risk. So again, thanks for watching. We'll see you next time.